since I'm a one-man shop, I don't have time to do all the grassroots research that a lot of these large mutual funds or organizations or investment funds have. So I have a very simple strategy to take out the risk. First of all, I insist on a low valuation. So, and that's why I asked you, have you guys done, do you know how to calculate enterprise value? Enterprise to sales, enterprise to EBIT. So I insist on a low enterprise to EBIT, normalized EBITA. Not EBITDA, but EBITA, earnings before interest, tax, and amortization. Real cash flow pre-tax as my first criteria. I must have that before I invest. Okay. The second thing I absolutely insist on, it has to have a strong balance sheet. And either it's a consumer product company and has interest coverage. You know what interest coverage? Everyone knows what interest coverage, EBIT to interest, EBITA to interest, of like 6, 7 to 1. So I absolutely know, or it has to have net cash and not burning a lot of cash. So it has net cash and it's not burning cash. So I must have, those two criteria. And then I must have one of either of these. Either it must be a good business or it must be a good management team. Very rarely will you get all 4 of those criteria. You'll get the first 2 pretty regularly. But you're going to usually have to choose between a good management team and or a good business. If it's a good business and idiotic management, which happens a lot, okay, that management team will be fired. The board will get tired of them, or some competitor will take them over because of the low valuation. The market will take care of that situation. If it's a mediocre business, like I've owned S&Ls before, savings and loans, which have very mediocre returns on capital, buy them at 60% of book, and they're very well capitalized. And management doesn't have to be rocket science to solve it. All they have to do is just buy back shares up to book value to add value, and that's what they do. I mean, they can't really do. They don't really understand that much the type of organizations they run. They're not going to add a lot of value by having a high return on capital. But if they know enough to liquidate, which most of them do, then you can make money that way too. But let's go back to the first 2 criteria. Why do I insist on the first 2 criteria? Because that's where all the risk is. Your risk is when you buy it at a low valuation, you take out a lot of the risk. And the lower the valuation you buy it at, not only do you have less risk, but you have more reward. So let's say if you value something in $1 and it's trading at 60 cents on the dollar, it's more likely to go to 60 cents to 70 cents than it is for 60 cents to 50 cents. And even if it goes from 60 cents to 50 cents, you just buy more, right? So that's the first thing I insist on. The second thing I insist on is to have a very strong balance sheet, because the reason why you're getting at a low valuation, it's unpopular. That stock is unpopular for whatever reason. We're buying from the bargain bin at the grocery store. There's something wrong with that business. That's why it's at a low valuation. It's either a cyclical problem, a macroeconomic problem, or the company just screwed up and it's a temporary problem. Hopefully one of those 3. Okay. And you want to be sure that that company survives its temporary problem. That's why the strong balance sheet comes in handy. They're not going to go bankrupt. There's no Chapter 11 risk. The second thing is the strong balance sheet allows them to buy back their shares. Okay. So let's say you have an economic meltdown like we did 18 months ago, and you're losing 10% a week in terms of price. And that's not even for someone like me, that's not easy to live with. I don't lose sleep, but it does make me feel a little anxious at times. I'm not going to lie to you, it does. But one of the things that you get excited about is that, wow, it's a lot cheaper than it was 3 months ago, and that company has a great balance sheet, and they're buying back shares. So when this economic crisis is over, they're going to come out of this more valuable per share, and that's all I'm concerned about is value per share. So when they have a strong balance sheet, they can take out the bankruptcy risk, and they can use that strong balance sheet to either increase their value per share, or if it's an industry problem, they can take out a competitor and take more market share per share. And then again, when they come out of the industry slowdown, they'll be more valuable per share. So you don't care. I don't care enough about the mark-to-market markdown to sell my position. In fact, I'm excited because they can use their strong balance sheet to buy back shares. If you have those 2 things, you can take out a lot of risk. So now let's take a step back, and I asked some of the early people here. what is risk. And if there's one thing that you know makes CP&E a little different than most normal investors. Value investors look at it basically the same way I do, but a lot of typical other institutional investors probably look at it differently, especially consultants and things like that. What is risk? Okay, did I ask you before? Okay, someone I didn't ask before. What do you think risk is? You in back there, the one with your pen. What do you think risk is?
Volatility, price, downside.
Right, and that's a typical finance. It's volatility, and I'm not saying that's wrong because that's what's in the textbooks. I love volatility, right? Because that's what gives me the price. That price volatility gives me the opportunity to invest in value and get the bargains that I can. Now, volatility in the stock price is the typical definition. That's what beta is derived from, these Sharpe ratios, all these other Greek letters. But risk to me is permanent loss of capital. You know, the fact that either the business is just not going to be there or not going to be the same way. Think about like Encyclopedia Britannica or newspapers or something like that. Or let's look at the financial companies out there right now. Like if you look at Citibank. Now Citibank, before the crisis, it made about $5 billion. It made nothing during the crisis. And after the crisis in 2013, it will make $5 billion. The difference is the number of shares they had in 2006 was 1/10 the shares I'm making these numbers up. I'm not sure what the exact numbers are. But 1/10 the shares that they're going to have in 2013. Because during the crisis, they were forced to sell shares to shore up their capital base. And that's why I said they didn't have, because they were so leveraged, they were leveraged 30 to 1 or something like that, they had to continue to raise capital to just be solvent. And that's why I insist on a strong capital base going in.
What do you think of Citibank's price right now?
I have no idea. I haven't looked at it. What's the valuation? What's the market price rate? What's the market cap?
At half times book.
Was that tangible book? Right?
Some book. I mean, how tangible is the book? I don't know.
Well, I mean, you know, you got GAAP book value, but for financial institutions, tangible book value is very important. And what is the equity to assets?
I mean, not many people believe the book. If you think that their books can change every day, you know, you just have to take a guess.
That's right, and that's why it's important to have you know, a very well capitalized firm with a very strong balance sheet. Now, it's harder to do with large financial companies like Citibank because you just don't know what's on their asset side or their liability side. I mean, they have the GAAP statements, but their footnotes are so thick and so complicated. It's always amazing when they say, well, we have 100 pages of disclosure. I would argue that if you have 100 pages of disclosure, it's telling you nothing. It's telling you, by telling you everything, it actually tells you nothing, which tells you everything, right? So the other concept, and this goes back to the strong balance sheet. I'm good. I got the water. There's a concept that I like to call weak money and strong money. And you always want to be strong money. You never want to be weak money. Now what's strong money? You never want to be in the middle of a crisis. You never want to have you never want to have a margin call. You never want to have to pay off your loan in the middle of a crisis or have your house foreclosure. If you are weak money, you are going to be in a bargaining. You're going to be put in a bargaining position that you're going to be a forced seller. Now, those people with strong balance sheets, companies with strong balance sheets, people with strong balance sheets, can take advantage of that weak money. The people with the strong balance sheets in 2008 and 2009 are getting paid at the end of 2009 and getting paid this year for the investments they made back then. And so those people, like, if you're a large financial institution like Citibank, you were automatically weak money. You had no choice except to raise money. If you were Lehman or Bear Stearns, leveraged 30 to 1, there were no buyers on Sunday afternoon, right? There's nothing they could do about it. Okay, I mean.